Hey guys, I just wanted to jump in for a second and let you know a little bit about today's live stream sponsor, DNA Funded. DNA Funded has very generous profit sharing up to 90% and 3 different unique challenge types. For those looking to get funded, they also have speedy payouts, unlimited trading days on the first and second phase of their challenges, a very wide list of different things you can trade with over 800 different assets tradable, and maybe the most important component, a very experienced team behind the whole operation. So if you're interested in learning more about DNA Funded, click the link, check it out, see if it's right for you, and make sure to do your own due diligence to see if what they have to offer fits your trading style. For 20% off, you can use code A1T20. Again, that will be 20% off any of their challenges you'd like to check out. Thank you again to DNA Funded for sponsoring today's live stream. Now back to the show. Hey guys. All right, we're back for another week in the markets. Hope you guys are doing well. Good morning. Happy Monday. Happy new week to you. And happy new week, but not so new market moves. We see stocks lower here into the session. You got the NASDAQ down 1.5%, S&P 500 down 1.3%. Gold is flat. What's new there? Gold has not been moving that much here recently. But hey, you know what? From my positioning standpoint, I will take gold trading sideways instead of stocks, which have been cratering lower. I will take that all day long on a relative performance basis. Gold is doing quite well. Can I show you a real quick chart? As if you get a choice of what I show you. You got no choice. We're looking at GLD/SPY. Check this out. This is a cool chart. You can build on TradingView. You can compare, just like you can with a currency pair, you can compare 2 charts. So what I've just done is the gold chart versus the S&P 500. And you can actually see that gold has been very strongly outperforming the S&P 500. You love to see this, especially if you're in longs like myself, but really nice gold outperformance here recently. You've seen stocks continuing to move lower. And the reason I bring this up is because, you know, as someone who benchmarks my own performance against the S&P 500, obviously, preferably, I want to be in charts that are moving better than the S&P 500, right? If you're going to generate outperformance on the S&P 500, you really have 2 ways to generate outperformance. Let's say yellow is the S&P 500, right? If this is the S&P 500's performance, right? Let's say that's over a couple years of time. If you're going to outperform, and this is the goal. If you're a trader, you may have a different goal than me, and I'll talk about different goals in a second. But if you're a trader, the goal is to outperform passive investing. And the most notorious example of passive investing is to buy the S&P 500 or the SPY, right? If you buy the S&P 500 and hold it, typically in good times like we've had in the last 20 years, 10% per year passive income is incredibly good. That is what you get, you know, historically. Now, I want to clarify, you don't get that it's not guaranteed. You could have 10 years where the average gain on the S&P 500 is 2% per year. We've just been living in a time where stocks have been exceptional in terms of their returns. But my point is, I like to benchmark my performance against the S&P 500. And you can outperform the S&P 500 in a couple different ways. On the way up, if you want to outperform, let's say that green is our personal performance. So let's do this. So this is SPY, right? So if I'm making up a theoretical example. S&P 500, it's returning somewhere around 10% per year, right? So if you're returning 10% per year by holding the S&P 500, of course, like I said, some big assumptions there. You've got a good stock market right now. This is a really good 10-year period to look at. You can outperform in a couple ways. You can outperform by having bigger returns in up periods. And if you're investing that way, you're probably investing in technology. But the problem is when the markets dip, you can easily underperform drastically, right? Because tech stocks have been getting killed way harder than other things recently. So if your portfolio is all technology, right, and you're trying to outperform, well, then what you really want to do is you want to try to, when markets have really good periods, this is my personal philosophy, right? You want to be long technology. I say you, the proverbial you. I want to be long technology stocks when they're on sale, but I really don't want to chase them off a cliff, right? You have to be careful with tech stocks and high risk stuff. What I've done here recently has been I've pretty much taken a lower beta portfolio. And what that means is I'm holding things like gold. I'm holding things like value stocks, things like that, right? Which in the down period will still decline, but they might not decline as sharply or as horribly as the broader market or tech stocks. So I've moved a lot of my funds out of high growth tech stocks for the time being, and I've stayed kind of risk off, right? Being risk off has allowed me to quote unquote outperform so far year to date by being less exposed to risk. It's kind of a hard thing to explain, but basically stuff holds up better or worse in crashes, right? Tech stocks get destroyed in crashes. They can be down 70%, 80%. Everybody loves them when they're going up. Everybody hates them when they're going down, right? So we've had a tech sell-off here recently. And so my point is right now I'm holding a lot of gold, which is leading to the outperformance in my portfolio this year so far, right? Gold has been holding up well while the stock market has dropped. Does that make sense? Again, you can outperform the market by taking high amounts of risk, and if it works out, and if you're buying like high growth tech stocks, those are high risk stocks. If the market's good, you'll likely outperform. But if the market's bad, you will drastically underperform, right? So you have to be careful where your exposure is. So for me right now, I've been talking about how I am positioned in gold, and I'm thrilled that I'm in gold, even if it's going sideways. Sideways is great when stocks are getting crushed, right? So again, relative performance wise, I'm okay with being in gold and sitting around and waiting. Being bored waiting for gold to make a move is the greatest circumstance I could possibly be in right now, as opposed to stocks, right? If I'm sitting in gold, I'm saying, look, it's not really going anywhere. This is kind of boring. I will take that all day long rather than just being super long the NASDAQ as it continues to crater, right? So you got to be careful with NASDAQ. It is one of my favorite things long term to trade and invest in and find good stocks in. But when it gets overvalued and the air comes out of the balloon, it can be a violent correction. Take a look at the NASDAQ here. So far, from the peak to trough, we are looking at about an 11.5%, 11% decline. The thing is, it's very common for the NASDAQ to see 15, 20% pullbacks, even in a strong bull market. So, is the NASDAQ a buy right now? Maybe. I mean, you're sitting at some pretty key long-term levels of support. But systematically, I don't have the right setups to really get long the NASDAQ, right? Technicals look good, but technicals are not the only thing I trade off of. If we take a look at the US economic heat map, still a lot of red in this chart. You got high inflation. This week, we get CPI numbers and PPI numbers. I'd like to see how those fall. Is inflation coming down, or is it still sticky and rising? You have to be really, really careful with what that looks like, right? If inflation keeps rising in the face of slowing economic data, last week we had non-farm payrolls slightly missed. It wasn't really a terrible NFP report. ADP, however, was a miss, right? We saw a big miss in ADP. That's the private payrolls. JOLTS job openings also missed. Unemployment rate went up, not by a lot, and we're still at 4.1%, which is a very strong unemployment rate. But my point here was showing you this is that, okay, the U.S. economic heat map is not as, impressive as it perhaps once was. So to me, that cooling economic data continues to favor gold, which is why, like I said, my primary positioning right now, I am long gold, and I have a stop loss below these lows. If that gets taken out, I will reevaluate the trade, stop out of the position. So if we drop here and fail at support, I'll stop out of gold and look for a possible re-entry back here at the previous all-time high around 2,800 to 2,780, somewhere in that range. Again, as long as we continue to have edge finder confirmation, that might be a trade setup for me. I'm also watching some currencies right now. Pound US dollar. I'm curious to see how that one's looking today. Let's pull up the pound. Here's the British pound. You can see really clean price action breakout here to the upside, looking really strong. Watching to see if this thing can pull back this week. So if you get a pullback in the pound, I may look for continued upside on this one. So I like pound US dollar to the upside. Let's see what else we have. Russell's getting a bearish reading. Dollar Swiss, bearish. Dollar yen. Yen cross is still mostly getting bearish setups here on the edge finder. Whoops. Australian dollar against Japanese yen. Look at the Aussie yen. This is such a very strong downward trend on the daily chart too, right? So that's a pretty key. You had this little retest here intra-week last week for Aussie yen. Sellers came in, hit that one back down. Most yen crosses look pretty weak to me right now. Aussie yen getting a very bearish reading on the edge finder. So pullbacks on that one could be interesting. I traded Aussie yen a couple times this year already and have had some pretty good success with it. We'll see if we can get another trade on that. TLT, the bond ETF, still doing quite well. Bonds looking really strong. Bit of a trend line here, long-term breakout to the upside, pulling back. I'd like to see this thing continue to follow through to the upside. This has been a hedge position for me on my portfolio to the existing stocks that I have. And if it continues to rip higher here, which I think could happen, especially if you get, well, CPI is going to be interesting this week for TLT. If bonds are going to go higher, you'd want to see inflation cooling, right? That would improve the probabilities that the Fed is going to cut rates, which is a bullish thing for bonds. Yields would fall. But yields have been dropping anyways, right? Yields have been on the decline here recently, which is part of the reason I think the dollar has had some weakness, right? That fall in yields dragging the dollar index lower and should theoretically help gold and silver. And by the way, foreign stock markets, usually a weaker dollar is a positive catalyst for a lot of other stock markets. So we'll see. But continuing to watch the dollar index, it's sitting at a really key level of support around 103.5. Let's see if there's a bounce this week for the dollar, or if that breaks, signaling, I would say, the next level of support is down at 102. And that's a pretty long-term level of support, 102 to 100. I mean, that range, it depends what happens with CPI. But if CPI comes in really cool, I would expect metals to rip, TLT bonds to rip, and dollar index to possibly make this kind of move here down to 100. I would not be surprised to see the dollar completely erase the gains that it has made since October of last year. I would not be surprised at all, right? You've had a significant change in leadership. The euro looks really strong right now. The pound looks really strong. The dollar looks quite weak and still seems poised to see up to 3 rate cuts this year. Look at that. NASDAQ stock market just opened up. NAS is down 2% on the day. We're back down to those lows of this recent pullback. Look at Apple. What's going on with Apple? Apple stock down 2.9%. Apple's a stock I personally love the company, love the products, don't love the valuation. I think Apple has room to come down personally. I don't own the stock. I've owned it many times in the past. I love the company long term, but just because you like a company does not mean it's priced correctly, right? I actually think personally, this is just not financial advice ever on this channel, but I think Nvidia actually looks great for some longer term upside. This company grows revenue, like they had great earnings recently, but the stock has gotten absolutely pummeled here recently, down 30%. I mean, this has been a serious correction for the AI leader. So I like Nvidia. I'm looking for opportunities to add more shares long term. I also like Tesla. I sold puts at 260, so it is looking like, and I'm happy about this. Looks like I'm going to get the shares at 260 if this stock continues to go lower. So these are long term companies that I like. Tesla's a high risk, high reward stock, so please be careful with stocks. You can lose money on anything in the markets. There's nothing easy about this stuff. It's very, very hard to make money. But I like Tesla for the long term. It's a company I've owned on and off. I've traded this thing for years, and it is one of my favorite kind of speculative stocks. It is not. It's got great earnings growth, but it's valued very, very high. And that valuation, if you're going to pay up for a very expensive stock, you have to, there has to be some massive upside potential. And I think robotics, they're talking about, Tesla's talking about putting in to their own factories, robots, right? Robotic manufacturing. I know that already kind of exists, but they're talking about putting in their own kind of the Optimus stuff, all the robots that they're building, the robotic AI stuff that they're building. They're talking about putting it into their thing, which I think is really cool. But what car do you drive? No, I don't drive a Tesla. I drive a Jeep, Jeep Rubicon. But yeah, I mean it's a high risk, high reward stock, but people have hated that stock since inception, and now with Elon Musk being, of course, super controversial. Now there's Tesla is just like the uniformly most hated stock in the world. Everybody hates this company. It's interesting. It used to be, and not to get political, but for a long time, Elon Musk, people liked Tesla because it was like the clean energy idea. But those same people now hate him because now he's like super on the other side of the politics world, and then it's also a hated stock because it is priced extremely expensively. And we've seen what happens to expensive stocks when markets. I mean, that's a 50% drop almost. That's a substantial drop in the price of Tesla shares. But it's controversial because, of course, Elon Musk, but bigger than just Elon Musk himself, it's controversial because the stock is valued very expensively. And some people argue that it's more just a car company, and other people argue it's more of an AI company. I would say I'm more of the latter. I think it's an AI company. I think it leads in a lot of the AI revolution. It's one of the, in my opinion, if AI and the stock market, continue to chum along, right? Tesla, in my opinion, has the potential to apply all that AI technology. That's the thing. Who can use AI to start making more money? Well, Tesla, self-driving cars, Optimus robots. There's many ways they have. They call them shots on goals, right? There's many shots on goals for this company to take AI, leverage it, and make it very profitable. But again, world's most hated stock is Tesla, I would argue. Nvidia is not nearly as hated as Tesla. Nvidia, anyways, talking lots of stocks, we'll move past stocks here for a second. Let's get back to what's happening in the dollar and gold here recently. Gold, again, for me, the boringness of gold has been great because this boringness has given me an opportunity to just kind of to sit parked in something like gold where stocks have been dropping. I mean, look at stocks again. NASDAQ was down 2%. We're now down 1.8% on the day. S&P 500 down 1.3%, pretty close back down to those lows. And we'll keep an eye on that to see where that goes next. But I still like gold quite a bit. That is definitely my preferred area. Also kind of maintaining a bearish outlook on the dollar and a bullish view on bonds. So we'll see if that can continue to play out well. Also, quick update here. We are kicking off this week. So last week we did some discounts on the Edge Finder. This week we are following through and giving discounts to people who are requesting them on our memberships. So if you're somebody who is interested in trading alongside myself and our team, if you'd like to see the trades that we're taking, you can currently get 30% off. We're matching the same offer that we did last week for the Edge Finder. We're offering it for our Discord VIP group. We had some people request, hey, can I get that discount for memberships? So we're extending it to our memberships option as well. If you're interested in getting access to our Discord community, if you'd like to see the trades that we're taking, we trade FX, we trade commodities like gold, silver, oil, we trade indices, we trade crypto, we trade a little bit of everything. We even trade stocks. If you'd like to see the trades that we're taking, throughout the week, every single update, every position that we enter and exit, you can see all of them inside of the Discord community. If that's something that you're interested in, take advantage of 30 to 35% off if you send us a direct message. We're doing 30% off, but for those who are watching the stream right now, you can currently get 35% off if you send us a direct message while we are streaming. Diversified portfolio there. Yeah, I mean, that's part of the reason, right? I don't trade one thing because I like to have a spread out kind of exposure to the markets. If you're all in on Bitcoin and Bitcoin crashes for 3 years, right? That's a really hard way to sustain kind of an income source, right? If you're just a crypto bull forever and the market enters into, if you'd bought Bitcoin at the wrong time here, you're sitting in a 830-day drawdown where you lost at one point, like what, 70%, 75% of your portfolio, right? So I like to have approaches in lots of different things. I trade, again, like I said, stocks, indices, commodities, crypto. I trade a little bit of everything. Like I said, I trade bonds quite frequently as well. So a little bit of everything. And with fundamentals as the centerpiece, right? The cool thing about fundamentals is it makes you pretty agnostic to what you're trading, as long as you understand the kind of underlying fundamental forces, right? So I trade, like I said, I trade all of these things. Currency pairs, metals, indices, cryptos, commodities, bonds, but it's because, we're looking at the fundamentals which drive all of these markets, right? You may have a preference, a favorite thing, right? Most people do. Most people like to trade a specific thing, but, and I do have my favorites, but I'm pretty agnostic to what kind of market we're in because I can trade lots of different things, right? I can trade currencies. They're all the same. It's just different names, but you're really trying to figure out, spot fundamental trends and how they could impact certain charts that we're watching, right? So like I said, I like gold and silver right now as bullish opportunities in the markets. We'll see if I can continue to spot some opportunities there. On the bearish side, yen pairs still look pretty weak to me. Indices, I'm kind of staying neutral. Although, check out this put to call ratio really quick. I do think that this is really worth keeping an eye on right now. And this is why I personally am not going to short the indices right now. If we take a look at the put to call ratio, you can see that we have a very high put to call ratio. Now, when the put call ratio gets extreme to the upside, what does that mean? Well, we've selected for S&P 500. For those of you who have the Edge Finder and you navigate to the put to call ratio chart, you'll also see that you can select oil, silver, S&P 500, QQQ, which is NASDAQ, gold, or DIA, which is the Dow Jones, the diamonds. You can select any of these charts and you can look at the options market volume for puts versus calls. And that is, to me, one of the most powerful sentiment indicators available to any trader. What we can see here is that recently, puts have been in high demand. You know what people are feeling in this market? They're feeling fear. They're scared. People are nervous about the uncertainties of tariffs and the fear around whether the Fed's going to do this or that, or are Trump and Trudeau going to figure it out, or there's going to be a full-blown trade war. There's so much uncertainty in this market, and you can see it expressed by the market in the put to call ratio. So the put to call ratio, again, we've built tools for this to keep an eye on it. When it gets really low, everybody's euphoric, everybody's excited, everybody's optimistic about the markets. When everybody gets pessimistic, it goes the other way. Right now, I'd say you're sitting in a pretty opposite of euphoric state. People are terrified of this market. So the reason I'm not interested in shorting the S&P, shorting the NASDAQ, shorting the Dow Jones is because that's the popular trade right now. If you need more evidence of that, take a look at the AAII Investor Sentiment Survey, and we can see that investors have marked feeling very bearish in the last 2 weekly reported surveys. Almost 60% on both weekly reported, 60% of people feeling bearish. That is very high. So what does that tell you? Does that tell you go out and buy the stock market right at this moment? No, but it does, in my view, tell you that if there is one spark, one glimmer of good news in this market, take, for example, maybe a good CPI print, maybe Trump and Trudeau figure something out, anything like that, the market on a dime could be up 2-3% like that, right? So to me, if you're a bear in this market, it doesn't mean just if you're bearish on this market right now, the stock market specifically, or you're bearish on the US economy and you're bearish on the dollar, right? You can look at these things and you say, okay, well, if everybody's in that camp, let me just dial it back, let me calm down. If you're bearish, right, you wait for these extremes to at least chill out a little bit. Let's say this week you get something like this. Maybe bearishness cools off, people get excited. Then there may still be the bearish opportunities out there, but you're not trading into the crowd. Does that make sense? Type yes in the chat if that concept makes sense. With sentiment, my opinion, you don't want to be chasing the extremes, right? So getting super bearish on the stock market right now, in my personal opinion, as always, is maybe a mistake. If you're bearish, that's fine, but maybe wait for some of the bears to kind of jump off the bench, right? Then maybe there's some downside. Maybe we see another leg lower. So we'll see. Anyways, up next, we've got Ivan joining us. Before we go to that break, let me just remind you, discounts on our VIP memberships are starting now. We are currently doing 35% off our VIP memberships if you send us a direct message during the duration of this live stream. During this program, like I said, if you send us a DM, there's the link. Click that link. You can speak directly to our support team, and we'll hook you up with a membership where you can get access to all the trades that we're taking when we take them. They get sent directly to your phone. If you're serious about your trading, you'd like to learn and trade alongside myself and my team, Frank, Ivan, etc., then definitely take advantage of that offer while it is still available. Okay, guys, we're going to take a quick break, set up, and then we got Ivan joining the call just after this.
Attention A1 Trading Show fans. If you're interested in getting free access to the Edge Finder or our premium trade alerts, listen up. For a limited time, our show's partnered broker 8cap is giving out free access to our products when you sign up for a new trading account with them. If you already have a broker, you may want to consider switching to 8cap because of their low trading costs, a wide range of trading assets, and their amazing customer support. If you'd like to get access to our software and Discord server for free, click the link being dropped in the chat right now and ask one of our team members for more information. Don't miss your chance for free products and an award-winning broker. Now, back to the A1 Trading Show.
All right, we're back with Ivan. Hey, Ivan, good morning or good afternoon to you, sir. How are you doing?
Good morning, sir.
Ivan, what's the dollar doing this week? Huge down move last week, cratered lower. For good reason, or is this oversold?
I don't even understand the reasoning. Other than we're gonna have a recession in 2025. Because I would believe dollar strength would happen now with all trade wars, inflation going higher. But it seems to be there is a different war before this war. Is the is a lack of growth war.
Mm-hmm.
So yeah, I believe dollar strength is going to happen any moment, any day, any month.
Yep. And so the dollar index here, I think even if you're bearish on the dollar as a theme, I think we've
Mm.
reached some pretty oversold status levels. Doesn't mean it has to go up, right? You know, oversold can get more oversold, but we're sitting at a pretty key level of support around 103.5, let's call it. I'm curious to see if this does have, the potential to see a larger bounce, but really, I think you probably, for the dollar bulls out there, you would need to see a catalyst, and maybe that catalyst comes in the form of a strong CPI report. Ivan, if you get a CPI report that's hot, what does that do? Like is the dollar? I know obviously that would be bullish for the dollar, but would that be enough to reverse course and maybe signal a longer term bottom? Is that all we need? A hot CPI print?
Um, why always leaving me speechless? I'm not clever. I'm not more clever than you. You're making all these answers,
I mean,
anyways.
we want to know. You're the Forex guy.
Yeah, now I think it's fragile. Cause if you get a hotter CPI number, that would be welcome. That would be great. That would be a short-term move higher in dollar. We got somehow hot NFP number on Friday, so that would be great. But the problem that I have, that I see that the market is pricing in, is what is beyond March or February, March or April, because this is activity that we are yet to see, or we see that has gone down. Like Canada has like not going to send any more lumber to America, which is going to have a lot of effect for the not the lumber industry, the house building industry, construction industry. So we are yet to see the effects of it, but so that's why I'm like, might have a strong one now, but the next one might be horrible because there has been no activity from, what is it, 20th of February or something.
Mm.
So yeah.
So here's another one for you too.
Okay. Mhm.
Part of the reason I think the dollar has been struggling
Mhm.
is if we take a look at yields, right? The
Mhm.
10-year yield, the 2-year yield, the 20-year yield, these things are dropping, right?
Mhm.
There is a lot of um, kind of repricing here of how many rate cuts we're going to get this year. In fact, I pulled up the watch tool.
Mhm.
What we can see is that the bond market is pricing in at this time one, two, three to four rate cuts this year.
That's
Small probability, but a possibility of rate cuts. Well, actually, I'm sorry. This is 3 in 2025 and then more in 2026. So up to 3 this year.
yeah.
Do you think that that's just do you think that's overzealous? Do you think do you think we probably only see 1 or 2, or do you think we can still see 3 rate cuts and the dollar still be strong?
Oh, I think what the market is doing is getting ahead of itself.
Mhm.
And because this is just belief. There is no concrete proof in
Right.
that we're gonna have a 3.5% 3 rate cuts by the end of this is December 25. Um, this is just what they're hoping, or what their data is preliminary telling us what to do, but it's not really reality, because we haven't seen anything other than GDP now being
Mhm.
forecasted to be negative. We'd had okay, NFP was great. CPI is about to come, but we don't have any numbers yet that is 100% Trump's kind of presidency in the second term. That is actually only him. What do I mean by that? We need to go. Well, it went in so February. Any numbers that comes out from February in March is kind of like his term, and what comes out in March, so that would be in April for March. That is after all these new tariffs comes in. Then we will see the immediate effect of tariffs, or whatever he has been doing. But the long term, what happened during COVID when we had all these container ships not being able to dock. that was a long term or a longer term issue. Then if that happens, that's kind of what I'm talking about, is we have to wait for the longer term effects also to come in, like a year down the line, of the effects of what is currently happening. And so markets pricing in the next 3 months, we're gonna have less activity. So I feel like they're just going for one idea and then see if it sticks or not. And then we'll have a rebound of dollar if it doesn't stick.
Yeah. Well, so I want to talk about this with you too, Ivan, and I think we might be having screen issues again with StreamYard. So hopefully you guys can see my screen okay and Ivan's screen, but StreamYard has been giving us some issues. But I want to talk about this thought too, because there's questions about if there is in fact a Trump and Fed put. What I mean by that is, if you get a substantial slide in the stock market or the economy, is there a point at which the Fed or Trump steps in and makes drastic changes to try and save the day? They call that the Trump put, right? Buying puts or Powell put, right? Buying puts essentially as protection. But I want to talk about the Fed for a second, specifically the Fed put, right? Let's say you keep seeing inflation sticky, but then you get jobs data start to roll over. We had ADP numbers come in pretty poor last week. Unemployment rate went up. NFP was okay. It was flat. But let's just say in the next few months, we see jobs data continue to deteriorate. Maybe the efforts of Doge do end up really hitting the labor market, and we see that start to cool. If that happens, where do you think the Fed, do you think the Fed acts on jobs, or do you think it acts on inflation, or do you think it does nothing? Like the Fed, so if you have stagflation, right, this concept that growth starts to slow, jobs data slows, the forward-looking indicators of the economy, travel, PMIs, these things start to slow, and at the same time, inflation is not going anywhere. What does the Fed do? It's kind of a challenging circumstance, and a rarity in Fed policy is this concept of stagflation, sticky rising prices. Sorry about that. But at the same time, growth metrics slowing. So what do you think? I mean, I have a thought. I'll share mine after you, but what do you think the Fed does in that circumstance?
I think what we did during I can find it. I wanted to have this one, but if you go to jobless claims, so they're like 250 now or so. Back in COVID times, I was hoping for more history, so I went to this one. I'm sorry. But if you go back to COVID times, it shot up like from 1 week to another, like 6,000, like from 1 week to another. When you see high volatility in the jobless claims, because it's a week, it's every week, or if CPI has a dramatic change, but it's also slower. Also, NFP is slower, and also PCE is lower. So I think they will look into jobless claims or anything that is every week and make a judgment call on what would happen to CPI, because CPI back in 2020, they made a drastic decision. I think it was 3rd of March and 15th or 19th of March. And the CPI number was only like 10th or 13th. So in between there. So it's too slow for us to be reliable when we have a dramatic change. Secondly, you can also look into the headlines, and you can start calculating how many people who is laid off. Back in 2020, it was everyone almost in the restaurant business or in service industry was basically what do you call them in English? Not let go, but you have like
Furloughed,
to go home,
but
you're getting paid or something. Like
it's furloughed.
Yeah, when the whole service industry that happens to you, then that's a red alert. So to answer your question, I'll probably say data and probably say jobless claims or anything else that I can't remember right now that is posted every week that has to do with labor or inflation.
Yep, fair enough. I think for me, if I was to try and make a pick, I think the first one they would act on is jobs. because inflation is at like 3%, right? CPI, and core PC is at 2.5. So inflation, the target is 2%, but that's their theoretical and ideal situation. It's not like if it is above there, it's all over, right? If inflation's at 10%, that takes precedence massively, right? But if jobs data, right now, I don't think it's at a critical level, like you pointed out accurately. I think you did, that was a great point about unemployment claims is not at like a critical level. But like if jobs were to really start to get critical, like unemployment claims seriously started to jump, I think that's the one they would act on first, because inflation has further distance, I think, to go before it is critical. But right now, I think the Fed is just going to sit there and do nothing. I think that the expectations for a whole bunch of rate cuts this year, well, 3. I mean, I suppose it's not too crazy, but are all up to what happens with the jobs data. If that claims data, as you just mentioned, starts to peak up week to week, then it is likely, I think, that those rate cuts are going to come in. But
Yeah.
so we'll see. It's really, really going to be interesting. I think the jobless claims week to week will be really important to watch. Speaking of which, look at this. We got NASDAQ fresh lows, guys, in the sell-off here.
Wow.
S&P 500 back down towards the lows as well. I mean, that is 2.26% on the day. NASDAQ is not messing around. And just from a technical perspective, guys, we have decisively broken below the 200-day moving average, which is, it's not some magical thing, but Wall Streeters love to reference the 200-day moving average as kind of your stronghold of support for a bull market. We've lost that. We're actually trading much lower now than the 200-day moving average. Crazy. Ivan, are indices, are they toast? Is there more downside? What do you think?
Is this Fox News or is it CNN?
It can be either one. Your pick.
I'll go by A1 Trading. But no, not really. I think what have I said before? I always love a downturn because it's always a better buying opportunity.
Sure.
And we haven't really seen a really good fall for a long time.
Yep.
So I love it. I like it. Until people start losing their jobs, then there is a financial application to people's lives. But for this, I only see it as whatever that is. Like, is this a turn? We will turn around. We'll get back in. And as we saw, I need to have more open this, but as we saw on the COT data, Russell, SPX, Dow is in the top, was it 4 or 5? Yep. Positive change in the last week. So yeah, people are buying it. So it's not really death, because if they were selling off most of SPX and Dow and Russell, I'd be a bit more worried, because that would accelerate the fall. So yeah, I don't think it's toast, but I think that a lot of businesses, and some businesses are completely out of business at the moment, need to reconsider their positions as to where they want to do business.
Ivan, I have a thought that I want to share with you. I think is really, really important about the stock market. So for everybody in the audience who is not a stock market trader, I think, Ivan, you're more on the long-term buy and hold side of S&P 500, and you don't trade it too often, right?
Yep.
So even if you don't trade the S&P 500, and there's always the degenerates in the chat that are like, go back to looking at gold or go look at the dollar again. What you have to understand is, even if you don't trade the S&P 500, this is a paramount indicator of risk sentiment in the markets. You can also look at Bitcoin, and I think that's a really powerful indicator. But I want to talk about something that I think is critical to this market right now, and why the stock market has massive impact on the US dollar right now. Here's why. The consumer in the last few years has been held up. A lot of the spending has been held up by who? Rich people. Who invests in the stock market? Rich people. People who have a lot of money in the stock market don't feel the effects of inflation as much, right? People who are on the wealthy end of things, they are not killed by rising egg prices. The middle class and people are impacted by that, but wealthy people, they're impacted by the stock market because a lot of their income, a lot of their money is sitting in stocks. And when stocks really start to go up or down, there is a wealth effect that goes with it. So when somebody who has a lot of money in the stock market is spending willy-nilly, they're taking vacations, they're buying a second home because the stock market's up and they feel good, when that reverses, so too does the consumer sentiment of the wealthy, affluent class. And again, they make up a very large portion of the consumer base. There's something interesting here. So if you want to talk about dollar strength, right? Dollar strength, sometimes people like to say, oh, dollar down, stocks up, dollar up, stocks down. It certainly is not the case. Not always, right? There's actually low correlation between the dollar and S&P 500. The dollar down and stocks down right now is not good. And stock market going lower hurts, I think, the dollar case, because what that could mean is the wealth effect for rich people who make up the consumer strength kind of stronghold, people buying American Express cards and, maxing out and spend a bunch of money on stuff, right? If they start to feel the effects of a slowing economy in the form of their portfolio, that impacts the consumer, which is, of course, a core component to dollar strength. So, who's benefiting recently from some of that? Well, FEZ is the Euro stock market. Europeans might have a little bit of extra change. Maybe the euro is a little strong because of that. There is some correlation. Remember, all markets in some way or another move together or they impact one another. So stocks do impact currencies and vice versa.
Mm-hmm. If you remember COVID times, this is exactly what you're talking about.
Yeah.
Probably shouldn't say the word too many times, but gold had a field day.
Yeah.
Well, first of all, gold had a pretty massive sell-off for liquidation of assets, and then it had the move higher of a lifetime, because I remember gold being at 1440, and that's kind of maybe what we'll see now. Maybe a gold fall because when you're getting to that critical point of we actually have to sell off our asset to secure other positions. If you say losses, another fun indicator is to go to, I don't know what you have in America. Do you have Craigslist or something? OLX or
Craigslist,
something?
yep.
Facebook if you start seeing luxury cars there,
it's a great indicator, Ivan. That is a forward indicator right there.
That's an indicator, because that happened during COVID. All of a sudden, you see these Porsche 911s and whatever Bugattis, and you're like, where did they come from? And collector cars, and you want to sell them now? Okay, give me a good price, I'll think about it.
Yes, no, you're so right. You're so right. That's a great, kind of subjective, or I guess anecdotal evidence of slowing or growing economies. I mean, those are forward indicators. Another one's really cool is TSA pre-check traffic in airports, right? So if more people are flying or less people are flying, those are indicators that are like real time, day to day. So there are things that are leading indicators beyond, what you can find in GDP. Now, of course, there's nothing magical about those two, because there may be reasons why people are traveling less or some seasonality to it and all sorts of things. But, keep your eyes peeled. And when you think about the wealth effect, stocks are what are the kind of currency to the affluent class, right? They own stocks, they own assets. When asset prices and stock prices rise or fall, so too does the consumer at that upper echelon. Their spending habits rise and fall too. So really important stuff. I mean, stocks dropping, that's no joke. I mean, think about if you are somebody that last month you had 10% more in investments than you do now. You lost, and that's being generous. Most people, the indices are a little bit deceiving because a lot of individuals do not put their money all in the S&P 500. A lot of people, they go buy Tesla, they go buy Nvidia, and those stocks are wonderful when they're going up. But if you put your money in Tesla, you've lost 50%. So people getting crushed in stocks,
Mm,
it has an effect. People feel they're like, oh, we're not taking a vacation this year. We lost way too much money in the stock market. We are gonna not take a vacation. So that is a real thing, and it is worth paying attention to. I think that you're seeing businesses concerned about what tariffs will do, and you're seeing consumers potentially hurt by, the middle class has already been hurt by inflation and rising prices, but now you may see the affluent class hurt by stocks. And I know poor rich people, their stocks went down a little bit, but that's a real thing. And then rich people make up a huge portion of spending in the consumer basis. So it does mean something to all of us when rich people slow their spending, right? So
mm,
I mean, yeah, stocks down has an impact on the dollar. I think it's why this concept, we got to get it, Ivan. We got to educate people that dollar down does not mean stocks up, or vice versa. There's not a perfect correlation between stocks and dollar, simply because why is the dollar dropping? Slowing economic data. Why is the stock market dropping? Slowing economic data. They don't always move inversely to one another. Now, why over in 2022 was that the case? That's where a lot of people learned this. They said, well, dollar was up in 2022 and the stock market was crashing. Well, that was
mm,
because inflation positively affects the dollar and negatively affects stock market.
mm. You have, I probably said this many times. I'll probably say this many times again. You have like four drivers of the market, generally speaking, and they have different kind of effects. One is the macro.
Mm,
You can call it also, yeah. So the economic data. You have risk, and then you have, which is political risk or geopolitical risk. Wars and stuff. And then you have, I would argue, seasonality,
mm-hmm.
and then you have sentiment. Those are always going to be the the drivers of the market. Probably going to find a few more if I think two seconds about it. But in different ways, and there was a gold question earlier. Why wouldn't gold rise, or why wouldn't also gold do as dollar does? Is because different asset classes has different properties as to what would drive them higher.
Mm,
For a dollar, for example, now we are actually pricing in lower inflation. We are pricing in lower interest rates. We are pricing in lower activity, but we haven't really seen it yet. The same thing with the stock market. But back in 2020, on the fall, we had, as the stock market was making higher highs and higher lows of an economy that was doing horribly, or was still in lockdowns, or was still not having jobs. But it was on the hope, probably the fifth one, the hope of a future. We had the Fed coming in and giving us $3 trillion in QE, and all of a sudden we were hopeful, and that's what's not necessarily what's going to stop the fall nowadays. But of course, lower interest rates would help. Lower 10-year T-note would definitely help of trying
mm-hmm.
to reverse the market and trying to get some positivity back into it. But at the moment, it's, I would argue, it's just a feeling or a sentiment, or yeah, let's call it a theory.
No, I think so. I mean, you said it well. It is very also that sentiment component. I would say falls under what we've been talking about as well, with the quote unquote wealth effect to asset prices. So,
Yeah.
the Fed themselves talks about this too. They talk about asset prices and how that impacts the consumer. It's a forward indicator. If you think about, if stocks drop, like I said, people feel like they have less money. If stocks go up, they feel, it's a weird phenomenon because, let's say that you have a portfolio. Well, let's just use the chart here. Let's say that you bought stocks right here and you said, okay, I'm in, right? I bought stocks. I'm invested. And then you see the stock market go up for a couple months and you say, I'm doing great. And you go sign up for vacations and you feel good. You feel, I'm going to go to the beach this summer and I'm going to get a new car. I'm going to go buy a Tesla. That's natural. I feel that. Everyone who has a stock portfolio might, if you have a stock portfolio, do you feel that way? Let me know in the chat. I feel that way. Like when my stocks are all up, when things are going really well and my portfolio's up, I just feel better, right? I think that's the most natural human feeling. If your portfolio has appreciated in value, if your investments, if you bought a home and your home value doubled in the last 10 years, you feel good. You feel great. You feel a lot better about where your finances are. But the same thing can be reversed. And now maybe you're saying, look, the thing has come right back to where you were. Now you haven't made or lost anything. You're just flat, but you feel way more in the dumps. You're like, well, I definitely need to cancel my vacations. I need to sell off my extra vehicle in my garage. Or it's amazing, the psychology of it, right? It really does. You feel it as a consumer yourself. So I don't know if people in the audience feel that same way, but I certainly do. It's a natural human experience. Your portfolio up, you feel better. Portfolio down, you're feeling a little worse. But as an investor, as a trader, there's something here too. When people get really scared, that is usually when prices get to be more attractive. You mentioned this earlier, Ivan, and I feel the same way. As stocks drop, obviously I don't like it from my portfolio perspective, but I love it for the long-term opportunities that we could find. We could find some great stocks or great asset prices in general going down. It favors people who have time on their side and the ability to wait patiently for longer term setups. That's my opinion on it.
To say what you're saying a bit differently, I would argue that people see the stock market as an extra income, or what they can fool around with. But it's where you have like your 401k or something, like your pension is in there.
Yes.
So you feel like your normal income covers your normal bills for normal activities, and then stock market is for extra activities.
Right.
And therefore you feel more positive when that goes up, because all the things you can do, all those possibilities, right? But yeah, well, I mentioned it because you guys have a different system, and then I believe that your pension is linked to the stock market, as of general at least.
Well, a lot of American workers have 401ks, or they have just there's just kind of the tax benefit ways to invest passively, and 401k effect is the same thing. Even though that's money that most people don't touch until they get past 60 years old, people it's still an effect. You still feel your portfolio going up and down. It has a real effect. So, Ivan, we're out of time. Great conversation as always. Yeah, we're kicking you out. We're kicking you out so that you can move on with your day. And Ivan is a father these days. He's got to move on to his fatherly duties. Okay, no more chart time today, Ivan. You've had enough chart time. No, but seriously, thank you for coming on. We dropped the link to Ivan's channel. Maybe we could drop there it is. Boom. Thank you guys on the producer side. Ivan's channel is right there for you guys. Do me a big favor. Go subscribe. Go check him out. Support his work, of course, for him coming on today. And if you're interested in one-on-one coaching, that is something that he also offers. You can send him a direct message. If you're in our Discord group, send Ivan a message. Let him know you're interested in some one-on-one coaching, and he can help you out. Ivan, thank you very much for your time today coming on. And again, go see your young child. No more charts today, okay?
I will. Thank you for having me.
All right. Thanks, Ivan. All right, guys. Always good to have him on. Again, Ivan, you can see why he is great for trading coaching. He's just very down to earth, and I always appreciate having him on. He has a good, practical, no nonsense. It's the Norwegian in him. He explained to me a while ago when I first met Ivan, I didn't fully understand, that there was a cultural difference. Where Ivan is just very straight to the point. And, I kind of am too, but not nearly as much as those Norwegians, man. I don't know about them. I don't know about them. Anyways, just kidding. We love Ivan. Anyways, guys, we got Chris Pulver taking over the show here just after this. Going to take a quick break and then let him take a look at some markets with you guys, talk some charts, talk what's happening. Again, stocks down lower again today, down 2.5% for the NASDAQ, 1.6, 1.7 for S&P 500. Gold still doing its thing. It's holding steady. And again, it's all about relative performance for me personally. So gold being flat today, I am okay with flat when the market's down. We'll see if we can get gold to break out, though. I'd love to see it take out those highs and push higher from here. VIX up to 13, up 14% today. Look at that. VIX at a 26.6. 26.6. I might need to go look at some opportunities to sell some premium here today at these levels. We'll go see if I can find some stuff on that. If I take any trades, whether it be FX, indices, commodities, I will be sharing them inside of our Discord server. And if you don't have access to the Discord server, you can sign up currently for 35% off. And what we'll do here is we're going to extend that. If you like Chris Pulver's stuff, we're doing a 35% off discount on all memberships, whether it be our group or the Pulver Alerts add-on. If you don't have that, you can get 35% off. Here's how you can do so. We'll drop a link here in the chat. If you speak directly to our support team, they'll hook you up while the stream is going with a 35% off discount to our memberships. You can see every trade sent directly to your phone and desktop that we take in full detail, explanations. You can read along with our journals and why we're taking the positions. And again, we'll extend that also to the Pulver Alert service, which is also available for members to take advantage of and see Chris Pulver's trades. All right, coming up next, we got Chris Pulver taking over the show. We'll be right back.
Hey everybody, thanks for tuning in to today's A1 trading session. We love engaging with our audience, talking shop, taking requests, and sharing our favorite setups. It's about that time where we're going to review a bunch of indexes, stocks, currencies, gold, silver, Bitcoin, and pretty much anything else and share our insights. If you're wondering what trades I'm in, if you're wondering what trades I'm taking, and you'd like to see exactly how I'm trading everything, you can actually follow my trading signals. If that sounds like something you're interested in, we'll share a link in the chat. You can sign up. You can sign up directly with the link or speak to a support rep if you have any questions. If you're asking, what do I trade? Pretty much everything. Indexes, ETFs, stocks, options, futures, Forex, and crypto. Thoughtful analysis, active trading. Check it out. And now, back to the show. What's happening, everybody? Happy Monday. I just am getting a screenshot up and running with a new trade getting posted in the Pulver Alert section. So have a look at that. If interested, I'm just selling some premium on the SPX. So we are sitting up with the implied volatility rank that I have on Tasty Trade around 51. That is quite high. The last time I saw it that high, that high was with our decline from July to August of last year. We crept up into like the 60s when this market was dumping over the weekend. The one thing I keep looking at is I actually measured this out just to be, I was curious this morning, take the length of that decline. Oops, let me use a different color here. Take the length of that decline from July to August and match that from these recent highs. And it's pretty close. So let's grab the measurement tool. That move was around 9.7%. And from the recent highs down about 9.7%, that would be pushing close to like the 55.50 area on SPX. So just keeping a close eye on this. I still go back to, we have April lows, we have August lows. I think this is a pretty good technical spot. The market's clearly trying to flush and test these lows again. I was pretty excited. Like Friday, I was out of the office, but it was nice to see the market closing, higher off the 200 moving average and actually take out the intraday high. But that was just wishful thinking because the market today so far is still flushing a little bit lower back down to those lows from Friday. What do we have on the docket this week? The docket this week, it's inflation week. Now, a couple ways to take a look at this. Of course, I don't know. There's no crystal ball here. But this is in the area that I think the market is willing to show at least a recovery. Maybe it's a short-term bounce. Maybe it's a dead cat bounce. Maybe it is just get the heck out of trouble position. I do have some hedges that are still going. which I'm fine with those. Like that is MES here. A lot of my MES positions. Right now I'm up around $3,700 on some hedges, and I've got an ES trade that's up another $1,600. So I do have some hedges running. I closed out a bunch of my SPY hedges. I closed out my MES and ES hedges last week. I have some fresh ones that are still running out to April and May. So I'm going to keep a close eye on those. I'm selling some premium today. I'm selling some premium out 40 to 50 days. But I want to talk about a couple technical levels. April, August, and we're at the 200 moving average. A couple things, just textbook overbought, oversold conditions. So what I'm noticing here on this is a MACD, is, we are making some fresh lows and we are getting some divergence on the MACD oscillator. We're also coming into some really nice relative strength oversold conditions. So the one thing that's going to be difficult and it might be tough to time, when we had this correction, all we did was we pretty much came down to the RSI 30 level and then started to go back up. I think the hard part is going to be spotting divergence, meaning this: if we go low in price and then lower low in price, if there's divergence there, then that could also signal a bottom. This week, I think with the lineup of news, it might be a little bit more challenging. A couple things with news this week. Truflation is a third-party inflation measure, and this did time the market pretty well by showing that when the inflation bottomed back here in September, it started to go higher, and that's exactly what the Fed data ended up following as well. So we had the lowest point of inflation was in September of last year, but since then we had that complete complete like cluster F of the Fed starts cutting rates and the bond market prices in something very different. And we saw that inflation started to get stickier and higher. We saw 3, 4, 5 months of prints in a row. You can see that also on your Edge Finder. Looking at your inflation data. So if you go to your inflation data, your year-over-year CPI, it's forecasted to be this week. I'll look at the Bloomberg economic calendar. So CPI is going to be the big one for headline readings on Wednesday at 8:30 a.m. Year-over-year CPI, previous print was 3.3, forecasted 3.2, and that's core CPI. So core CPI year-over-year 3.3, forecasted 3.2, and the year-over-year CPI 3%, forecasted 2.9. So the market's looking at a slight improvement. If it is not a bigger improvement than that, I'd be a little bit surprised. This is what I'm talking about. We have seen from the September levels here, Truflation called that bottom in September, and the market's been going and experiencing higher inflation ever since. So that's 1, 2, 3, 4, 5 prints. So inflation is trending back to where we were back in July of 2023. So, a year and a half ago, inflation's really made zero improvement. Okay. Now, this would justify where the Fed says, inflation is, I don't know if we can use the word transitory without getting in trouble, because that's what got Powell in trouble in the first place. But if it shows that we are actually trending lower again, or getting a reading that's lower, that's probably not a bad thing. So lower inflation, I think, could get the market a little bit more excited this week. A couple things on the technical side. So here is CPI data. Here's core CPI. Okay, and then PPI year over year. And we also have our core PC, which is the end of the month. This is the, kind of the wrong direction we've been talking about. Truflation calls that bottom in September. There's your readings going up, showing that producer price index year over year is getting stickier, getting worse, not improving. But all of this, from this recent high to this current low, is actually lower than September. So that does make me wonder if, based on where we are at for these year over year readings, if we start to see some traction in the right direction. Okay. So that's why I want to look at the calendar this week to see what the forecast is. It's a modest improvement, 3.3 forecast at 3.2, 3% forecast at 2.9. I would say the market this week can get a little bit more excited if it prints better. So if we print 2.8, 2.7 on the year-over-year CPI, if we print 3.1, 3% on the core CPI, I think the market might be a little bit more excited. Technically speaking, this is in a spot where I could see a couple things playing out just price action wise. Either the market, gaps down on CPI News Wednesday and then fills that gap with some opportunistic plays to the upside, or we have a gap higher that has some follow through. That's probably the trick this week. Is I don't think the market's just going to stay, same price, close and open, close and open. I think we're going to have some gaps this week to deal with. So I wouldn't be surprised if the market either gaps higher on CPI data and then pushes up, or the market gaps lower on CPI and then fills the gap and then actually has some bullishness. But this is the area that I've been talking about now for the last 30 plus days. Connect your lows, connect your lows. This is a spot that I want to take some bites. Okay, I'm going to take some bites in here and start looking to position myself for a little bit of recovery. Let me just go to some straight technicals. So this one, we have the MACD crossover. I'm looking at this histogram really closely to see are we starting to see any more divergence. My relative strength, are we getting close to the oversold, which we are. We're close to that oversold. I have one other workspace I can pull from. Harmonics and pivots is one of my noisier but classic workspaces where I'm looking for oversold conditions. So we got a ton of indicators on this one. Qs also pushing lower today. SPX pushing lower. We got a big demand zone between now and around 54. So between current price and 54, big demand zone. This is the level that I talked about as well. So connect your April and August lows. You can see it. There's demand down here. So that's a good technical indicator. You've got support from these levels. That's a good technical indicator, just driven in price action. If I go to my subgraphs here, I'm not seeing any divergence yet with momentum, but I am getting close to seeing some relative strength getting oversold. So I would say it's close. It's not perfect. It's not going to be perfect. It's impossible to be perfect. But noticing where we've had some relative bounces on this RSI, I don't see, because the market has been selling off pretty aggressively, I don't see the disagreement in the momentum oscillator yet. That may not happen. I would say this: if we go high, low, lower, high, lower, low, then I'm obviously going to be watching to see if there's hidden bullish divergence there, or the market starts to go back up and comes back down, but we have hidden bullish divergence there. That might help signal, a stronger bottom, to be determined. I know that if we have a rally, right? If we have a rally coming to the upside, I think that rally to the upside would still be relatively contained. I don't see the market necessarily going back above 6,000. So I think right now, you look at all the structure here, resistance and support and resistance. You can just see how this market has bounced around quite a bit around that 59.50 level. I would just say round number around 6,000. So between about 5,900 and 6,000, if anybody is long in this market, that to me is a fantastic profit window to get yourself out of some trouble, to start, even considering some deleveraging, to maybe re-up on some puts and hedges, which I will do, because the hedges I put on so far this year have paid out really nicely. And if we come back up to a spot where I would say, okay, well, if we're not going to make all-time highs, we have another flush lower, I want to have another chance to take this market down, right? So it's that simple. I don't know what's going to be the catalyst this week, how price is going to play out, but like I said, this week, either we have a flush move to the downside. Another technical indicator I just noticed here is the yearly pivot. So we have large demand level, yearly pivot, a little overshoot of the 200 moving average. But until price action ultimately decides that it's going to go back up, we're just watching this slow death to the downside. You know, the trajectory and the speed in which these bears are taking control it's slowed a little bit. You know, I mean, it was like pretty aggressive there for about 6 or 7 days. That Monday flush we had, and then Tuesday, Wednesday, Thursday, Friday, a lot of indecision. Today is just a slightly lower low, but not by a ton. So watching this carefully. I'm going to keep a close eye on my trade for this morning. I have some SPX running this morning. My 250 is trading for about 225. Got to take profit there in $2. I also have a broken wing down here at 55.85 today. So I'll keep a close eye on that for the morning. But hopefully we're not going too much lower than, I mean, we're already down 111 points from the close on Friday. So market's already reading, a lot of red, right? We've got S&P down almost 2%. Equal weight's down only half of 1%. Qs are down over almost 3%. So I mean, we're getting a pretty nasty sell-off where I would say the market is certainly not loving this. I don't know what it is about these Mondays, but we've had now this is now the second Monday in a row that's just been like, hey, just Monday dumps, I guess. So that's where we're at. All right, let's keep a look at that. So does that make sense? So we got some technical reasons, right? April, August, connect the lows. You got some technical reasons here. You have some demand coming into the market right around that yearly pivot around 56 to 5,400. The yearly pivot's around 55.59. The good price action would be that price is below the 200 moving average, and then price turns green and gets back above it. That'd be a good indication. Kind of put in a near-term bottom, and then see if the market can rally off of that. Is it possible for the market to rally all the way back to all-time highs again? Maybe. Anything is possible, but this market would have to be way more excited about something optimistic than it is right now. Because right now it doesn't seem like this market is excited about anything. Every day, look at the economic calendar, Trump is on it. And he's not saying anything good. All he's talking about is tariffs, retaliation tariffs, all the executive orders that they've signed. And even the address to Congress last week, it's like you've got one side of the room that doesn't want to do anything to support it. And then you get the other side that would do, I mean, I feel like as lemmings, they'd probably just jump off a cliff if he led them to it. They're all drinking the Kool-Aid right now. So whatever that looks like, it's going to be an interesting 2 years because midterms is the one spot, in our election process, midterms deciding whether or not people like how things are going. So Republicans have the majority. If they want to pass stuff and shove it down the throat of the U.S., then now's the time to do it. And that might come at a fair amount of pain in the markets, right? So the other thing that I think everyone was expecting was like there's going to be a Trump put in the market that these guardrails were going to be, he's going to be willing to, if he sees dips in approval ratings or if he sees the markets, breaking down equities wise or breaking down bond wise, that he starts to be more vocal on, picking things up or trying to jawbone things, which is still to be determined. I mean, I thought I heard this this weekend. It was an interesting podcast to listen to. I think since presidency this year, he's only tweeted referencing the market like less than 5 times. Back in 2016, I think over the course of, I don't know what it was, over the course of his first like 60 to 90 days in office, I think he tweeted over like 100 times talking about the markets. So certainly focusing on tariffs, and the market is not getting the the Trump jawboning like I think they want. So I think we just have to wait. Okay, Mags, another one. Mag 7 is down, right? This is led by Tesla today. Tesla is down to like $240. Yeah, we're 239 on Tesla. That trade, fortunately, was in profit. Now I'm looking at a potential assignment here around 255. This is out to March 21st. This isn't that far away. I don't know if Tesla is going to be something where, this gap gets filled and then the market starts to respond back up. I'm looking to see if this gets greater than 255. So I am watching that closely. Yep. So this one is like Tesla's taking away some of my buying power, which is kind of lame. So I mean, I don't know. I might end up taking some small losses on Tesla, which is fine, but it'll be frustrating. And officially, so last week I've kind of maintained that like, oh, I'm up for the year. I mean, it's not like I turned red for the year, which is insanely frustrating. So even despite, some of the hedges and adding an extra like 25 or 30 grand in hedges over the last couple of weeks that have paid out, just this like slow Mag 7 bleed and some of the premiums that I've been selling, it's unsettled. I mean, it's not realized losses, but I am just currently watching like a lot of option positions and seeing how things are going. I mean, the index IV rank is quite high. So obviously I would say about 75% of the time I'm selling premium, 25% of the time maybe buying options with spreads and just trying to mix and match. But this 270, 260, that's a ratio spread on Amex out to April, out to May. I mean, I've got some exposure, and we'll see. But there's definitely going to be some hardcore management. There's going to be some frustration and pain. And I'm just trying to make sure I don't do anything stupid. I mean, that's really what it is I've got to be willing to lick my wounds and accept some losses. I need to make sure I've got plenty of buying power to take some action that I want. If I want to dump positions, it might be in my best interest to dump positions and not take on the necessary or the unnecessary heat. I don't mind taking assignments on some instruments. I think Tesla is something I would be willing to own. I mean, if you were to tell me that we had an opportunity to buy Tesla at a 51% discount, I think they get a lot of traders excited. Now it's like nobody wants to own Tesla. But I still like it. I think the premiums are incredible. But the point is like if I can own this at 50% off, I mean, is it possible that Tesla is going to be as volatile as it was here when we declined back in 2021 to 2023's bottom? Like Tesla took a long time to find a bottom, and that was a 75% pullback. Are we going to do the exact same thing again? Right? I mean, we did break a recent high, but we coming all the way back down to these lows again? I would hope not. I mean, I would hope that this support matters and this support matters. And if we fill some gaps in here around this like $200 zone, that Tesla's going to find some type of support. But momentum and dumping positions and seeing this big rotation on a Mag 7, Tesla could certainly retest what is fair market value, which is showing to be like $130 to $140. So if I do see, any real ownership position, it is take the shares, take the assignment, and sell as much premium as I can to work this into a $20, $30, $40 net position. Take some profit on this one. Bigger picture would be that Tesla ultimately carves out lows, and over the next 1 to 2, 5 years, whatever, maybe we get back to these highs. But I don't think it's going to feel great for everyone to think directionally that it's like we're going to get back to all-time highs. Maybe. I mean, I am questioning the market's ability to get back to all-time highs without having the price to earnings multiples on the S&P go back to normal. We got up to 24, 25, 26 times multiple, and I think it probably needs to see a contraction. One thing that's happening right now with cutting government spending and tariffs and deportations, like all these things are going to be contracting growth. And we don't know what's going to happen with the inflation story. I mean, a recession probably lowers inflation, right? Why? Because people are getting laid off, people are going to spend less, and you've got less money chasing goods as opposed to too much money chasing too few goods, right? So anyway, Mag 7. Right now, the decline is, I mean, all of them are selling off. Like Apple's back down post earnings. Amazon down to 192. I have some exposure right here on Amazon as well. This expiration is out to next Friday, not this Friday, but I'm watching this closely. What else do we have? Let's just go down the list. So you got AVGO as well. We had a pop in earnings, but it's faded hard. They had positive news last week. It's not enough. This is now in the Mag 7 picture, or whatever you want to call it. Fantastic 8. I don't care. It's one of the $1 trillion companies. Now it's $867 billion. Nvidia's been one of the bigger stories, down to 107. We take a look at Nvidia's found the yearly pivot. I think this is a scary part about Nvidia is the next demand level is all the way down here towards like $90. We're below the 200 moving average. We're coming into some pretty decent support around these August lows. Anything around $100 on Nvidia, I do think is still a pretty good bargain. it's clearly in some trouble. I think fundamentally there's some good support levels. Technically, there's some good support levels, but this is probably my biggest concern about being a stock picker in 2025 is a stock that is good fundamentally, like Nvidia, still makes a ton of money, has a ton of cash, has these huge margins, has a huge head start. Nobody's really competing with Nvidia, but the market can price in our reality that can be very, very grim. I mean, Nvidia could come down to, $80, $70, and you're sitting here like, how the heck is Nvidia down 50% when it's one of the most profitable companies fundamentally in the entire stock market? Doesn't matter. It's what price is, and that would be probably rivaling what happened to, Cisco during the dot-com bubble was down 90+% and still hasn't recovered off those highs 20 plus years later. So just be careful. That's all I'm saying. I mean, I don't mind owning some shares of Nvidia, but I'm not trying to sit here and say I'm going to hold it all the way back to all-time highs. If this market has no interest in 2025 trying to get back to all-time highs, if anything, this has been a clear rotation into other sectors. If you look at the sector performance year to date, okay, we've got consumer discretionary in red. We have consumer staples doing pretty well. That's what people need, right? You got healthcare doing pretty well. Materials doing well. Financials have taken a big hit. They were actually up, leading the way. Utilities were doing okay. But now we have, S&P index is down year to date wise. We have consumer discretionary getting killed right now because this is going to be the anticipation of people cutting back spending. Whether you're in the top 10%, top 20%, if people are watching the stock market decline, that is going to be a direct correlation whether or not they're continuing to spend and feel like on paper they are, having the wealth and having the discretion to spend. Technology is down. I'm staying out of QQQ for the time being. I want to stay out of tech for the time being, outside of some individual stock exposure, but it's not great. Healthcare leading the way this year. Surprising. I'm okay. I mean, I've got a little bit of a XLV exposure and J&J as Johnson & Johnson. That's about it. Insurance wise, I'm in PGR and CB, but from compared to last year's performance, right? I mean, the last year, energy has given back most. Energy right now is up about 2%. So anyway, there's just a pretty obvious rotation. It's no longer Mag 7. It's no longer tech. There's a rotation into, I don't know if it's necessarily less beta, but I would say that traders, investors, one thing I'm watching closely is going to be 5650. Okay, we got a fresh low on the morning. One thing I'm watching closely here is J&K is high yield bonds. So your AAA, BBB, CCC. Right now, this is still relatively tight, which is a good sign. The other thing I'm watching is LQD. This is another thing for investment grade corporate bonds. If this starts to really move lower, and mainly J&K, if this makes an aggressive move lower, then we are still going into a risk off environment. I mean, this little slide in the market is the unfortunate thing about having market cap weighted, is because Mag 7 is so large with the 30+% concentration that it had, that even just those stocks individually declining is dragging the indexes with it. Right. So that's the hard part about such high concentration, is that those stocks turn over, 5, 6, 7, 8 stocks that turn over, and the indexes go with it. From peak to trough right now, I think we're in like a 7 to 8% window. Yep. So we're down about 8+% on the S&P this year. We're back down to equal lows on RSP, but it's still actually been holding in there a little bit better. Futures wise, we're at some fresh lows. I actually might take a look at my futures play. I might be looking to take some profit today on futures. I put this trade in for that's a 350 point move. I'm not in close, but I'm getting what I want as far as like long call, or long puts, and even this bear put spread. If I can take another like $500 to $1,000 in profit, it might just be worth protecting, and then getting ready to kind of take those, like maybe keep one eye open, take a little bite, take a little nibble, and hope that CPI data does improve like I think it can, because this is showing in real-time data that we should see some reasonable inflation data improving. The question I'm wondering is it going to improve this week? Right? Like, is the market going to see it as a reason to get excited this week and start to return? Or is it like more pain ahead? We just have a horrible quarter, and then the market kind of picks itself off, dusts itself off for April and says, okay, it's Q2, we can have something different. I don't know where the pain is, right? It's either we flip hard for this like February sell-off in this early part of March, and then the seasonality picks up where, middle of March into the end of the March is a bit of recovery. We start talking about this pre-summer push, market stabilizing a little bit more. But yeah, certainly a challenge so far this year. Okay, so let me take a quick peek at that trade's looking good for full profit next Friday. This trade's looking good for a little hedge, up $400. Silver still looking good for some profit. Okay, so question is, doesn't cost me a lot. Right now, got in this trade for $22.75. It's up about 100%. I guess I'll wait. I mean, I want to take profit, but if this also flushes lower, I want to have those hedges. I want to have the hedges running. It's only quarter percent, but if I can get this quarter percent to pay me, 1%, that's at least helping a little bit, helping alleviate some of the red. All right, that's where I'm at. Let me check my SPX for the morning. Still at 51 IV rank. My 250 is trading for 220 or so. Still need a little bit more time. Okay. Been in the trade for just over 2 hours right now. Okay, so watching that closely. I've got a take profit already set, so if it goes off during session, that's good. Let me make sure I don't have any conflict here. I am good for the next probably 15, 20 minutes. All right, that's good. Okay. Let's continue with top down. So S&P is down over 2%, NASDAQ down over 3%, Dow is down less than 1%. This is another one. I actually looked at selling some premium on the Dow today. The IV rank is high, but unless I'm just going to throw in I guess I could consider doing this. Man, it's like I would love to buy the Dow somewhere around a like 9 to 12% correction. So anything like 400. Let me check this really quickly. I might just put on a put on the Dow. So if I go out 51 days, end of the month on the DIA, we can go April 25th. Ugh. I mean, the premium just like falls off so aggressively on the DIA. This is why I love the instrument, but man, the premiums on this, just selling options, it's kind of bogus. So I could sell it $400, but that takes up a lot of buying power. I was only getting $2 of income. That's kind of a crappy trade. So if I flip this over, buy, sell, buy, sell. It's not terrible. If I did this trade, this will only be on my PM accounts. Let me check this one really quickly. I'm probably not going to take this trade. 23.46. Probability profits about 95%. I mean, it's another income trade out to the end of April. Man, it's not a bad trade at all. 390 be my ownership price. If I own the Dow at 390, that's what I thought's pretty safe out of the way. 390 from all-time highs would be a 13.5% correction on the Dow. Okay. 1, 2, 3, 4. This one I think is an IRA account, so I'm probably not going to do that. I don't want to tie up the 40. It'd be 40K cash, but probably these 3 accounts can handle it. So it's not bad. Bid, mid, ask is pretty wide. This is what I'm noticing from today's price action. It's a little bit wider than what I want it to be. But if I can still get over $2 on the trade, it's not a bad income trade for 46 days. Good probability profit. I could repair it. I guess the question I have is, how lucrative is a covered call if I went out about 25 to 30 days? I mean, at the monies this is high implied volatility, but at the monies, $7 to $8. Okay, I think that'd be a pretty easy repair. So let me see here for April 25th. Buy a 400 put, sell a 395, sell 390. That's a 111. Only ties up 23.44 in buying power. I'm going to take this trade. So let me see if I can get 210 to 215 credit on this one. 215 credit just got filled. Now 214, now 213. I said hopefully 210 can fill. Jeez. Well, that was a generous fill on the first account. 210 not filling. 210 did get filled. Okay, good. And last one, 7336. Crikey, that was fast. It's going to work this down. Hopefully I get filled. 209, 208. If I can't get filled over like $2, I'm not going to take this trade. $205, come on. Okay, that just went, that credit mid price went from 215 down to 164. That seems a little nuts, but I'm just going to try to get it down to $2, see if it'll still fill me. If it doesn't, I'll cancel that trade. That's no big deal. 202, 201. All right, I just got filled at $2. Okay, so I'm adding that in. That is a 425 expiration. Buy the 400 put, sell the 395 put, and sell the 390 put. Collected $2 to $2.15 credit. All right, so if I'm assigned on that DIA trade, unlikely assignment, but maybe about maybe a 10 to 15% chance of assignment. But with IV at 64.8, that's pretty high. Man, that's really high. So I should be able to see the expected move that I'm selling premium on is oftentimes going to be much greater than the actual move. So let me go into here. There'll be a 390 minus 5 minus $2. I'd own shares at 383. Okay, and I try to repair that for hopefully, $5 or $10. Okay, keeping a close eye on here. All right, keep going down the list. Russell continues to plummet. Income trade down to 190. We're trading at 202. Watching this one closely. Out to May as well. We are coming into a Yearly pivot, we're coming into past resistance, multi-year past resistance, 2022, 2022. This is a January cluster. This is August. This is February. This is August again, 2023. Technically speaking, this area hopefully offers up some type of bounce or at least relief. Russell is down about 17.5%. If it gets really nasty out there until the Fed starts cutting rates, Russell, I mean, I'd like to see this kind of 18 to 20% level, maybe bouncing off of that, offering some relief. But, I've got to be mindful of, this thing might drop 30%. This might be just a giant range, right? We go from this high to this low. Is this the support that's going to matter, or is it somewhere in between? I don't know. Maybe this offers up a short-term bounce. Get out of some of the pain trades and, watch your butt, protect the downside. IWD selling off more. That's your Russell 1000. Then you got your Russell growth down even further. I'm probably not going to touch this one until the Fed starts cutting rates, maybe second half of the year. Top 200 growth or value. This one, if it pulls back into maybe equal lows around 78, I don't mind this one. Again, those small caps, I'm a little skeptical on small caps. Volatility continues. This is a slow burn to the upside, which is pretty unusual for the VIX. Usually what we don't see is just like this slow, steady VIX increasing. Usually when VIX goes up, it's like aggressive spikes and then it gets faded. Aggressive spikes, faded, aggressive, faded, aggressive, faded, aggressive, faded, right? Not this time. So definitely different the last couple of, I'd say the last three weeks especially. We just had like a slow and steady VIX that's been on the rise. I do wonder if we have like a little capitulation move to the upside before this thing gets faded. So I just want to keep an eye on this one. VIX above 30 would hopefully be the spot where, okay, we've had some fun with long vol. We get up into maybe the high 20s or 30s, and if VIX starts to fade from there, that could be another way to kind of time any type of short-term rally that the market might give us. Okay. SPXY, another instrument that I'm going to watch carefully simply because this was a July to August decline. And, we've had that steady move on the volatility index. And so if I'm looking to fade that volatility, this is not a bad spot to be looking long. So I may actually put in a trade here around $40 and see. We'll see. This is oftentimes a good one to fade volatility. I'm just curious, like how large of a position. I might take a little bite here at $40, put in a pending buy trade if it gets there. But I also don't need to step in front of some impulsive move again on the VIX. If we get like a big spike to like 32 to 35 on the VIX, I just want to be careful. Because I don't know I don't know where that puts the SPXY. I'd like to think it's not going to go too much lower than 38.50 because that's where we had that August 5th bottom. But you never know. So I'll just continue to watch this one kind of day by day. Hopefully I get a good opportunity to, fade some volatility. Dollar index, crazy, man. This dollar index is nuts. Could be, it could be worse. We could have dollar strength in the wake of all this stuff. It could probably get way worse out there. But with the dollar weakening, I wonder if that's going to pull yields down. So oil, not interested in calling the bottom here on oil. My nat gas position is making some fresh highs. So I've got this one potentially getting called away in April at 23 for a nice little win. I could consider rolling this one, which I might end up doing. Take a quick peek at this right now. And check my UNG position. Right now, I've got about $500 out of my max. I think it's like $6.75 will be my max profit. If I wanted to roll this, I still have 23 days left in that trade. If I rolled it up 50 cents, I don't know if this is going to fill. If I could roll it up 50 cents and out another 12 days and get another 30 cents, that's not bad. I don't think this isn't right. There's no way. if I roll the strike up by $1, there's no it should be offering, the same amount of credit. So I feel like the bid mid ask is quite wide. So I might just let it get called away. I'll keep an eye on it. Gold, pretty choppy, and I think Nick said this earlier. I mean, the nice thing is gold is being pretty resilient. I don't know if that's a good or bad thing. I mean, obviously, gold is probably one of the better hedges to have right now, simply because it's not Bitcoin. It's not risk. It's not risk appetite. Like gold is safe haven, and this entire run we've seen for 2025 has been because of the safe haven bids. It's been kind of a stockpile. More central banks are trying to keep, whether they're diversifying away from the dollar. It's not Bitcoin. I don't believe necessarily that gold is like the best or better, but it is nice to see that anybody that's bullish in gold, at least something performing wise, is doing okay. So resiliency, but I still think we pull back. I think gold still has a pullback. But wait. Gold futures, silver. Silver's looking fine. I'd like to see silver start making some fresh highs again. We've had a nice little run here where, silver had a little bit of a bid to the upside from like 31.20 up to 32.70. And at that time, gold did kind of the same thing. But I want to see if silver can get the upper hand and maybe outperform a little bit and clear this high around 33 and change. Bitcoin, we said watch this previous high. Watch this 75K, right? Watch that 75K if it's going to offer some support. Probably the cleanest trade on Bitcoin right now is if you're calling the bottom, there's your technical resistance becoming support. That's the scary part. The best trade on Bitcoin right now is probably to stay the heck out of the way until this thing starts to break the trend line with some confirmation. That to me is the safer play, less stress, and just stay out of the way. I don't know if Bitcoin is going to be in typical Bitcoin fashion, which is, hey, welcome to a 50% pullback, right? And all of a sudden, all this consolidation here, Bitcoin's back down to like 60 or 50K as the market is kind of deleveraging. We'll see. I know Bitcoin probably trades a lot differently than it has the last decade. There's certainly a lot more securitization. There's more regulation. There's more legitimacy. There's way more flows to it. But gains that have been had, so gains that have been here, accumulation here, gains here, it's like that profit. You're going to see, how diamond hands the world really is about Bitcoin, because now that it's in more places, now that you have, the IBITs and the other ETFs that have had more flow than GLD in its first year, what it took GLD to do 8 years, it took Bitcoin or IBIT 1 year to do. You're going to see how serious people are about it. So 75K previous resistance becoming support. Watch for that level, and certainly watching for a bounce here and maybe a trend line break for some more confirmation. MicroStrategy, all the way up here towards 321, now all the way back down to 250. Just insanely volatile right now. Coinbase at 192. This one I've got a potential level 195. Gosh, it's going to be another one where I'm going to be curious. This is out to March 28th, the end of the month. So we'll see if the market gets a bounce. Maybe there's no assignment here, but give me opportunity to hopefully clean up some of this sell premium. Copper, this trade is looking good. Japanese yen futures making some fresh highs. Nikkei not really doing much. Japanese yen is getting stronger. Is this another kind of deleveraging event? I think the scary thing is that this all happened July to August. Right now, we've already started to see the signs of this thing heading higher. But you got to wonder, like, if we have another deleveraging risk-off event that happens as fast as what it did in those 3 days when the Nikkei went down, 20-something percent, and a 17% chunk of it was in 3 days. You got to wonder, it's like, how bad does capitulation get out there? I don't know. So this is why I'm long Japanese yen. FXY, 6J, that's ways to keep some exposure without getting caught up in the negative swap in the currency market. The DAX is pulling back. Fine. I still think DAX is still a good instrument to buy. It's been one of the best performing indexes this year. My exposure to this is with FEZ, just selling some premium. FTSE, previous resistance becoming support, maybe some pullbacks in this dynamic support level. Argentina pulling back a little bit more. I might take a stab at this one, but I'm going to do some research here. I want to find out, like, why would I be investing in Argentina? Because it was a great performer last year. That doesn't mean it repeats that. China pulling back a little bit. Brazil showing some resiliency, which is fine. Mag 7 again, just dumping hard. We did the Apple stuff. Apple, Amazon. I'm going to put in AVGO. There. So Amazon dropping. AVGO had positive earnings last week, but it's fading. Google down to some fresh lows with some gaps. Meta continuing to work its way back to this 200 moving average. This one, again, may offer a bounce. I'm just not that interested in calling that bounce or bottom. If we go, I don't know. I mean, if we bounce here, I could see a short-term rally, but I don't know if this market is able to get back to highs and Meta's going to do it. So I'd almost rather see something like this, a high to low, lower high to lower low, and then start get positioned with Meta having some reasonable pullbacks. This is past resistance becoming support. I know that's a huge cleanse, by the way, but it's not about like, oh, the company is. I mean, look, Meta is insanely profitable, but it's having a 700+% rally and throwing on a 1 fib. To me, this is all it is, right? So we either pull back to like this 25 to 50% zone, and if you're willing to take some bites at it, then I'm sure Meta's fine. But technically speaking, I'd love a chance to buy this thing under like 450. 450 to 350, I could position myself and justify like a medium to long-term position on Meta. Microsoft, right now trading at 380. Another one that has some exposure. This one is done for profit already. This one is 375. Son of a gun. This is going to be an interesting week for Microsoft. I don't really want the assignment. If I take it, I take it, but I don't want it. I can always dump it for a small loss, but there'd be an assignment at 375 if I took the shares. So if Microsoft gets below 375, watch for potential one assignment. All right, so chart alarm set at 375 on Microsoft. Netflix working its way down to the 200 moving average. This one should be fine all the way down here to 655. Not really worried about that price. NVIDIA 106. A lot of demand in the 190 zone. I've got some ratio spreads out to April. Tesla just selling off like crazy, down 50+%. Potential assignment next Friday if we're below 255. We'll see how eager people are to come into the markets and buy any of this stuff. I mean, it's on sale, but Tesla, technically speaking, 220. 220. I mean, I'd say that's a good technical bounce. If we're going to have a bigger capitulation, then we're talking Tesla back below $200, which would feel pretty terrible. And I don't know if this is like some weird sentiment play against Elon Musk where it's like, he comes in as Doge and he's just offering up chainsaw firing and terminations and shaking things up in DC. So I have no idea if this is a play on that or just because it's overvalued. Berkshire Hathaway off of recent all-time highs. Resiliency is good in this one. Let's go 10-year. 10-year, a little bit of a 3 to 4 day rally. I'd like to see this thing flush down to some fresh lows this week. That'd be pretty encouraging, especially if inflation readings are lower. It'd be nice to see a fresh low on the 10-year. So let's see if we get some fresh lows. Hopefully we do. I'd love to see some fresh lows. Especially if we're facing this like recession. I mean, I'd say the risk of recession is certainly not zero. I know this has been a heated topic for the last 2-3 years. Markets are climbing the wall of worry. Everyone thinks it's going to be a recession. Then it's not. And now nobody thinks it's going to be a recession, and that's certainly not the case. Like sentiment has made some pretty aggressive swings. But I'm going to watch 10-year yield. Futures wise, like I said, as long as J&K is not dropping off a cliff, I think we still have some liquidity in the market, so keep a close eye on that. All the jobless stuff, continuing jobless claims, core PCE, all these like data points we've been watching month after month. I mean, the big one this week is going to be CPI, PPI for Wednesday, Thursday. China, Alibaba still hanging in there. Baidu still hanging in there. FXY back up towards September highs. mean, China's showing some pretty decent resiliency. JD, oh baby. So I need this to stay above 40 bucks. It's at 40.60. Man, this is crazy. This went up to $46 and has faded hard. JD had positive earnings. What the heck? Well, I'll just keep repairing it, I guess. I need it to, if it stays above 40 bucks, to get it called away next Friday. So if it doesn't, then I'll keep selling premium, lower this cost basis a little bit deeper if I can. Schwab dividend, Schwab growth. Dividend's looking attractive. This is why I bought a bunch of shares of this 200 moving average. So not a big mover, but from a $27 to $29 position, it's not awful. Just got filled in SPX for profit. Thank God. Trade took 2.5 hours this morning. Good. So taking the profit there. All right, let me do a quick update. Okay, Schwab growth, staying out of growth, going into dividends. This is your defense, right? You want defense, you want lower beta, and you want dividends. That's going to be adding some resiliency to your portfolio. I don't think that's a bad way to go. My SCHG, this would be SCHD positions. So I'm in both. I'm up $1,100 on dividends, and I'm down, $2,000 on growth. So it's going to wait. I think what I'm going to do today is I'll look at the basket of SCHD, and I'll see, maybe this is better exposure for me rather than trying to play a bunch on the Dow. Is I just buy this and buy this basket and let this current kind of 3 to 6 to 12 month environment play out where the market is getting way more defensive right now. This also has a decent dividend around 3.49%. The beta is a 0.54. So the nice thing about this one is, if the S&P moves a point, this is only moving about half a point. So you're taking away a lot of that unnecessary, scary volatility when things are getting more elevated. But you sacrifice it both ways. When the S&P rips up, 50 points or 100 points, this thing's going a fraction of that. So it's just playing for safety. But a 3.5% kicker is not the worst thing. But I think this one is certainly looking a lot better than SCHG. And then we got some individual stocks. So, all right, I'll go and wrap up my segment there. I got another class coming up at 11:30. We'll be back and do it again tomorrow. Okay. Ford. Ford at 920, that gap up to $13. I mean, maybe it's the delay in tariffs or the exemption of tariffs, right? Or concessions in tariffs that would maybe help Ford. I did read something last week that Walgreens is potentially in the works to get bought out. There's going to be, let me see if I still have my shares of Walgreens. I do. So I still have shares of Walgreens, and I was reading they're looking to get bought out at like an 8% premium. So most likely that position will transfer into whoever owns them unless they're being taken private. If they're getting bought out and it still stays public, then it's all good. So, all right, I'll let you go. I'll see you tomorrow. Thanks, everybody. Bye.
Thanks for watching today's A1 Trading Show. Be sure to subscribe and to turn on notifications so you don't miss the next one. Want more from A1 Trading? Check out the links in the description below or our website a1trading.com. We have lots of free trading tools and channels available for you. We hope you have a great rest of your day, and we'll see you tomorrow.